Hi, it's time for the 2023 rate and housing forecast. Wanted to first thank Dan and Barry Habib from MBS Highway for sharing some great slides that we can use in this presentation to help get some good information out to you about the housing market, real estate, mortgage rates, and the overall economy coming up here in the year ahead. So without further ado, let's get started. So one of the things that we've talked a lot about over the course of the year is how inflation drives mortgage rates. And this, past couple of years, the Fed has really stepped in and through the QE period, quantitative easing, when COVID hit, and they started buying up mortgage bonds and stimulus, and that really drove inflation lower and lower and lower, and that in turn gave us all-time low mortgage rates. And you can see in this graph here, this white bar is the quantitative easing period, and inflation lowered throughout that period. And as the Fed stopped their quantitative easing, you can see that 30-year mortgage rates spiked up, and that's because inflation spiked up. And then towards the end of the year here, we have seen inflation come down a bit from the Fed's actions of raising the Fed funds rate several times during the course of the year. And mortgage rates in turn have come down a little bit. So we're off from the highs from earlier in the year, which is great news. And that's going to continue going into 2023. So the next, piece here is, when will inflation peak? And it's going to be sometime in the coming months here. And the reason is, the way that the consumer price index is calculated is they take a monthly reading on prices, and then they add that up for the previous 12 months, and that's the CPI. Well, currently it's about 6% year over year, and that's going from November's numbers of this year back to December of last year. So if you look at each month going forward, 1 month gets removed from the numbers with the new month's added numbers. Well, the numbers we have here, July, October, November, March, are all much lower than where they have been. So when you start replacing October, it's 6%, November 5%, December 6%, January 0.6%, February 0.5%, all the way through June, and then even August and September. Once those numbers get removed, we're going to have lower CPI, which is going to lower inflation. So I would expect sometime by the middle of the year, we're going to see a significantly lower inflation rate, and that's going to be great for everyone across the board. Another thing we've talked about through the year is why rates are so much higher this year. It's not just because of inflation. The additional factor that's caused rates to jump up this year is the spread between the 10-year Treasury yield and 30-year mortgage rates. So traditionally, and the reason is there's a spread because the investors who buy mortgage-backed securities, not the lenders, but the actual Wall Street investors who purchase bundles of closed mortgages, they need a return on their investment. And typically the spread between the 10-year Treasury and mortgage rates is somewhere around 175 to 200 basis points. So let's just say 2%. 200 basis points is 2%. So if a mortgage rate was 4%, if the 10-year Treasury was 4%, you'd have a 6% rate. That's traditionally the spread. Currently, and since really the 2021 going forward, the spread has spiked up. And now we're sitting at almost 300 basis points spread. So a 3% jump. So if Treasury yields are at 4%, now you have a 7% mortgage rate. And that's what we've seen here this year with the high surge in rates. So the good news is that spread is narrowing. So as we started to see rates come down a little bit at the end of this year, that's because the spread between the 10-year Treasury and 30-year rates has decreased. So again, good news going forward, and that's going to continue. Next, we all have been hearing on the news, recession, and frankly, that's a reality. And two things to look at here are the surge in credit card and revolving debt usage. Really, it kind of bottomed out summer of 21, and since then has just spiked up to levels we haven't seen in a long time. Same thing, the opposite, personal savings. That spiked up here during the stimulus period when the Fed was giving everyone money, and that money was going into savings accounts. That spiked up, and then sure enough, summer of 21, it's been going down ever since. So those are two big look ahead factors to predict a recession. Another predictor of a recession is the inverted yield curve. And that's where you look at the 10-year treasury minus the 3-month treasury. Typically, the longer term treasury is going to have a higher yield. Well, currently, that's not the case. So it's inverted. So this line here is the 0% return. And you can see in all the times where we've had an inversion, this has been a predictor of a recession. Recession here, recession here, recession in 2008, and here 2020, and then we're going to be headed for it again here in 2023. So time and time again, the inverted yield curve is a predictor of a future recession. So it's coming. Next, want to look at housing demand and household formations. Currently, there's a demand of a need for 1.3 million households, and the supply is just not catching up to that demand. So you've got 1.3 household formations, you've got 105 new homes completed, but then there's some that are lost through, they get old, they're out of the market, they're no longer usable. So the total supply is really only 1.4 million, and you have 1.3 new household formations. Builders have been cautious since the Great Recession in 2008. They have not really gotten back to the correct level of building. So the inventory is not there. It's really just the existing homes that are being sold. And unfortunately, right now, those aren't coming onto the market as much as we need them to, and that's really causing the housing shortage. The media, again, the big thing they talk about is, home prices are up so high, we're going to have a crash. This is awful. Well, if you go back, here's this chart shows housing prices from 2013. So going back 10 years, we're up 115% in price. We're up almost 40% just the last 2 years. And we're currently down about 2.5%. Most of the forecasts predict a fairly flat 2023 in home prices. Some are saying a slight decrease, some are saying a slight gain, but let's even just say it's flat. That's hardly a housing crash if prices are down 2.5% from up 115 just 10 years ago. So not something to panic. You got to remember, the news media creates headlines to sell the newspaper and get viewers. They're not necessarily giving the whole story. Here's the big one, though. Affordability is the key. So we all know that rates have shot up. We all know that home prices have gone up. And again, the news is yelling, people can't afford houses, people can't afford houses. So let's take a little look here. Last year, you were looking at a house and needed a $400,000 loan, and you had a 3.5% interest rate. That gives you a $1,800 a month principal and interest payment. Okay. Now today, we have 10% appreciation as of last month's report. So that $400,000 loan would now be a $440,000 loan. Rates are currently around 6.25%. So that monthly principal and interest payment jumped up to $2,700. So over a $900 a month increase. And that's the piece that you see on the news, that the payments have gone up $900 and people can't afford it. But what they're not also talking about is the rise in incomes. So let's say that borrower had a household income of $9,000 a month. According to ADP, people who stayed in their job got 7.6% raises, and people who switched jobs this year got 15% increases. It's an average of 9%. So using that 9% increase, That $9,000 a month income is now $9,810 for this year. So really, the spread in housing costs to income is only about $100 a month more, even with the higher loan amount, even with the higher rate. It's not that big of an increase, okay? But here's the issue. We also had such high inflation this year that everything else got more expensive too. So the average gas price went up $89 a month. Food went up $79 a month. And I think that's a low number. Services, $73. So costs actually went up over $1,150 a month, not just the $900 on the mortgage payment. So there's the difference where the $1,154 to the $810, that's the affordability gap where people are starting to feel it. Okay. But now let's go into this coming year. Okay. As we said, we know home prices are going to be flat. So let's assume it's still a $440,000 loan amount, but interest rates are forecasted to be lower because inflation is lower. That means a 5% rate. Now your principal and interest payment's only $2,362. So it's $807 more than the original $1,796 had you bought the house last year. Okay, but incomes are expected to increase again this year. Instead of 9%, let's just say 5%. So now you have a $1,300 a month more increase to your income from last year with $800 a month increase in cost. So now you're ahead, and the income is more than the increase in the monthly payments. And inflation will be lower, and those other items, gas, food, and services, will go back to normal prices. So the affordability is really not as big of a problem as it appears when you turn on the news. You have to look at the whole picture. So let's wrap this up with the actual housing forecast and mortgage rate forecast for 2023. So in the coming year, we know there's going to be lower inflation. We know the recession is going to slow down the economy. We know incomes will increase to help with affordability. There will be a very tight inventory of houses for sale, and rents are still expensive and still rising. That's going to give us a low single-digit appreciation rate for most of the U.S. As I said, I'm going to base it on basically flat growth for 2023. Mortgage rates. Here's the factors that are helping us. Global quantitative tightening, which is lowering inflation, and that's the inflation is the counter to mortgage rates. Lack of foreign central bank buying and more debt being financed. Those are the headwinds of the mortgage rate market. And then the tailwinds are lower inflation, excess retail inventory, increase in mortgage servicing value. That goes back to the spreads, and recession is likely, and mortgage rates typically decline during recessions. So the forecasts from MBS Highway predict mortgage rates roughly around 5% during the first half of 2023. So within the next several months, we're going to come down from the mid to lower sixes that we're in right now down to about 5%. That's a huge drop, and we were up over 7% just at the end of October and the beginning of November. U.S. 10-year treasuries are also going to fall. The yield should be near 3% or lower. It's currently closer to 4%. All good things for mortgage rates. So the housing market is going to be flat. Mortgage rates are going to improve. It's going to be a good time to purchase a house. For all of you that have been sitting on the sidelines, waiting, worried about interest rates going up, worried about housing prices going up, the time to strike is going to be in 2023 because the rates are going to be on your side. There won't be quite as much competition as there has been in the past. You'll be able to negotiate with the seller and get concessions, which can help you even buy down the interest rates lower. So there's a lot of good opportunities ahead. Any questions you have, if you're ready to get pre-approved and jump into the market, or at least get ready to jump into the market maybe for the spring, now's the time to talk and have that conversation. So reach out. I'm here to help and here to answer any questions anytime. Have a very happy and healthy and prosperous 2023.